So good afternoon, everyone, and you're very welcome to our fourth in a series of webinars that have been put together by Deloitte here in Dublin and obviously BPFI. My name is Brian Hayes, I'm CEO of BPFI, and we're delighted to see you on again. We've had a wonderful series of webinars in the last number of weeks. This is our last in a series of four. We've been looking at issues from fintechs to digital banking to payments. In a funny way, I think today's webinar on the future of the banking environment is probably the most important, because if you look at some of the very significant contributions that have been made about banking in Europe of late, there are huge question marks and huge challenges that I think we face as an industry. Jean-Pierre Mustier, who's CEO of the UniCredit Group, is president of the European Banking Federation, which BPFI is a member of on behalf of the industry. And he gave a speech recently about the challenges that the industry faced, the lower for longer interest rate environment, the lack of profitability, the huge amount of trapped capital that exists in the system, what kind of appetite exists from investors from an equity perspective in terms of, say, the M&A agenda, what kind of environment are we going to face in terms of Europe being too overbanked. All of these, real big issues, challenges, if you like, for the sector. But at the same time, there are opportunities. And I think one of the things we're going to try to do today in looking at how the environment is affecting the entire industry at a European and US level is to see potentially what are the opportunities that will inevitably flow from this. So we have a really good lineup of speakers today, led by Margaret Doyle, who is partner and head of financial services and real estate research at Deloitte in the UK. And Margaret's going to lead out in terms of the keynote speech that she will give today. Also joined then on the panel later by John O'Byrne, well known to us all here in banking circles in Ireland. John is Director of Products at Bank of Ireland, and as indeed is Diarmaid Sheridan, Senior Bank Analyst for Davy. Both John and Diarmaid are very well known here in town and elsewhere. And that discussion will then be moderated by Sean Smith, who's Partner and Head of Risk and Advisory for Banking at Deloitte here in Dublin. So you're very welcome to this fourth in a series of four webinars. We look forward to your contributions later. It's been a really lively series. Huge numbers of people have been logging on and listening to the debate for about an hour or so in the last month or so. And really hats off especially to Deloitte, who we've worked together with in bringing this series to you at such a crucial time for the whole sector. So Sean, over to you. Thanks a lot.
Thanks very much, Brian, and good to be working with the BPFI again on this set of webinars. I think, as you said, some really interesting topics and some really lively debate over the last four, so hopefully we're going to top it off with the last one. I think the topic itself, it's very broad, and I would say probably quite timely given where we are as an industry. Obviously, there has been the challenges, the financial crisis, but I suppose, more recently we have seen the bank's kind of business model come under attack, and then more recently again, obviously, COVID occurred. So I think there's lots of things going on, but equally lots of interesting things happening. The industry is changing at a significant speed, and the velocity of that change and the complexity of that change is a really exciting place to be. Challenging, but exciting. So in today's session, we're going to focus primarily on the macro influences on the banking industry, how they're shaping the industry. And then when we move to the panel, we're going to be focusing more on the particular impact of those changes and those impacts on the Irish banking infrastructure. So with that, I'd like to introduce Margaret Doyle. Margaret is my colleague from the UK, but she's an Irish native, as you'll soon tell. And she's going to bring us through some of the macro things that we need to be thinking about as we look forward on the banking environment.
Thank you. Thank you very much for that kind introduction, Sean. And in fact, not just an Irish woman, but a proud Wexford woman. So as Sean and Brian both intimated, the purpose of today's discussion is to take a really broad look at the context for our industry, for the banking industry. I know that you've kind of been focused on some specifics for the past few panels, but today we're going to take a really bird's eye view. And if we can move on to the next slide, I'm just going to kind of try to kind of talk you through the kind of very much the kind of macro global themes. So really look at, you know, globalization and what it has led to in terms of, in particular, the rise of emerging economies, and specifically China and India, or one might say specifically China. Now that globalization has brought huge prosperity, but of course that has not been split evenly. And so I'm going to kind of talk a little bit about that. We've also seen certainly an apparent productivity slowdown in the West, and it's something that has really perplexed many economists. There's a lot of talk about the productivity puzzle, but as you can all know and well understand, if you don't have growing productivity, it means that lots of things become more difficult. You end up with a kind of rows over dividing the pie rather than everyone gaining. The other kind of key themes that we're seeing is big demographic changes. We've seen that many economies are aging, led by Japan, but also China and Europe. And then other parts of the world, you've got burgeoning kind of young populations, but clearly that's kind of creating challenges. Climate change, another big item on our agenda. We've seen that that's really risen up the agenda and the priority list for central bankers, for politicians, and of course, therefore, for banks and businesses and for people. And then, what are the consequences and the kind of risks that arise out of all of these contexts? Well, really, it's kind of we've seen a rise in populism. In fact, not most recently, just the elections in Eastern Europe over the weekend. Geopolitical tension rising, it seems, by the day. Trade wars, and a question over, to what extent have policy tools been dulled from overuse. So unlike, when we went to the global financial crisis, we went into the current kind of COVID crisis with interest rates very, very low. Brian was talking about that low for long, low for very long. So if we can move to the next few slides, I'll just kind of talk you through the rise of China and India. And the context for this on the next slide we'll see is that we have been through a period of, frankly, breakneck globalization. Now that it's not completely unprecedented. Students of history will know that the late 19th century was also a period of huge globalization, mass emigration. You had the development of things like refrigeration and the railway, which helped kind of globalization and obviously developments in shipping. But we've also seen in our own lifetimes a massive expansion in globalization, and you see this here in the proportion of trade as a percentage of GDP and how that developed, basically over the lifetimes of the people on this call. And so been very fast with a few bumps in the road along the way, most notably with the global financial crisis. You can see that kind of sharp dip in 2009. But broadly, it's been a massive increase, and a big spur to that increase was the opening up of China in particular under Deng Xiaoping from 1979 onwards. And if we look to the next slide, we can see the result of that, which is that we've seen that China in particular has led emerging economies in an expected doubling by 2024 of their share of world income over just 2 decades. So, 2 decades is really a very short time over that period. And if you look at the proportion that China accounts for, we expect that China will have basically quadrupled its own share of GDP over that period. So China in particular being the driver. In fact, some emerging markets are expected to have shrunk. So there are some emerging markets in Latin America and Russia that have not sort of benefited over the last period, not least because things like the price of oil and gas shrinking. But China really growing the fastest of all of those economies and really becoming a very powerful player on the world stage. So if we kind of look forward to the next, if we can go through the next slides, please. We can talk a little bit about productivity. I'm sorry, the division of the spoils of globalization first. So there's a famous chart here, if we can look at that next, which is kind of, some people call it the elephant chart. So really, what this is trying to show, and there's been huge debate about this chart, but if we sort of take it at face value, I think that there are a few really key messages from it. So on the left-hand side of this slide, you can see that, you've got a rising bottom 12%. And so this is the emerging middle classes in China and India. And so And until a few years ago, and clearly there are tensions rising now, but basically the likes of the IMF and the World Bank saw the rise of China and the increasing prosperity of China as being a huge success story. Hundreds of millions of people have been raised out of poverty. Hundreds of millions of people who were hungry are no longer hungry. So, and to some extent, that's not a surprise. It's not a surprise that you've had a degree of catch up and that you've had people who are very poor who are now becoming middle class. On the right-hand side of the slide, though, I think that has been a bit more problematic, which has been the 1% that we really started talking about. If you remember back in the days after the financial crisis, 2011, people, the Occupy Wall Street movement, that was when people really started talking about the 1%. So the top 1% has become very rich in the aftermath of the global financial crisis. So if we move to the next slide, we can see that Chinese per capita income has risen and is forecast to rise further relative to American per capita income. So again, in many ways you can see this as unexpected. You've had a degree of catch up, and also you've seen that it's not surprising that that has happened, and in many ways it's very welcome. Of course, you then come on to the question that we have now about the sort of geopolitical tension, but certainly not surprising to see that emerging economies, and China in particular, has risen relative to America and is expected to rise further. The next slide talks about that 1%. And really, the 1% was already very wealthy, around the time of the financial crisis, but really a very striking increase in their share of global wealth, 5 percentage points in the aftermath of the financial crisis. And why is this? I mean, I think a lot of people would say it is the indirect and unexpected consequence of what central banks were doing. Central banks rode to the rescue, sort of said, gosh, we can't let the financial system collapse. So it was as if the whole system was on life support and they were pumping in liquidity, lowering interest rates. And in many ways, of course, it succeeded on its own terms. You had Ben Bernanke in the Fed, a keen student of the Depression. He was determined that we wouldn't have a repeat of the Depression. So we didn't have a repeat of the Depression. But an unexpected consequence was that those people who are wealthy became even wealthier, largely because of just, if you discount the value of that future expected stream of income by a lower interest rate, it's a matter of simple mathematics that the numerator gets bigger. So if we can move to the next slide, this is another way of looking at the distribution. We've been looking at wealth, but it's not just a story about wealth, it's also a question of income. And so again, those who are at the top end of the income scale, this chart is talking about the US, but it's a pattern that we've seen repeated elsewhere. They have done a lot better during that era of globalization than the median or than the bottom percentile. And the next slide, and I found this very shocking when we looked at this, is that again, in the aftermath of the financial crisis, incomes have stagnated or fallen for 2/3 of the population across advanced economies. So really striking numbers here. The proportion of households that have not seen their incomes rise or indeed have seen them fall. So very, very high proportions. And again, we'll talk in a moment about kind of some of the consequences of this. But in terms of populism, but I think, when you see a chart like this, it does explain that backdrop. So the next few slides, if we can move on, we're just going to talk about productivity. So there appears to have been a slowdown in productivity across the world in the wake of the financial crisis. We've taken out the financial crisis because it was a very volatile period here. But again, you can see the trend, okay, quite volatile, but broadly upwards in the run up to the financial crisis. And we have seen it decline since. I say appears because, economists, and there may be many economists on the call, will have very strong debates about this. There is one school of thought that says actually it's a measurement issue. We're not fully capturing things like, in particular, technology. Those of us of a certain age will remember black and white TV, from our childhood. But frankly, and of course, you look at the sort of kit that even teenagers have at their fingertips nowadays. You look at the sort of travel that people have. So there is an argument there, but clearly there is still an issue, I would argue, around productivity, which of course makes issues of distribution very difficult. If we also move on to demographics, This is looking at the aging populations in certain parts of the world. So overall, the world is aging. That's what this chart shows. And you've certain parts of the world that are aging very fast. So Japan has been aging very fast. Europe is aging fast. And North America is aging fast. Africa is not aging as fast. And clearly, one of the sort of side effects of that is that we may well see, we've already seen over the past sort of 5 or so years, we've already seen, after this, the Syrian war, civil war, we saw a big wave of migration to Europe with a large youth population in North Africa, in the Middle East, throughout Africa, and also with, maybe the economy is not expanding very fast, and with high unemployment, and on the other hand, you've got an aging European population. There's definitely going to be, I think, a rise in migration or attempted migration over that period. And then if we move on to climate change, so before COVID, I think we were all very focused on climate change, and I think in particular there was a revision of the predictions within the past year. We didn't think we were doing well, and then the revisions showed that we really were doing less well than we expected. And certainly on current policies, we are nowhere near hitting the Paris targets. And if we move to the next slide, this is something that used to be seen, even though, frankly, climate change has been an issue for a very long time. It was back in 1992 when we had the Rio summit. So it's not like climate change is a surprise. But I think what has happened is that, with a few notable exceptions, not least some famous politicians, but with those few notable exceptions, frankly, I think there is now a general acceptance that climate change is a profound problem. And it's moving from the periphery to the core of C-suite concerns, as you can see from all of these headlines. And also, it's something that for our industry, it's something that both politicians and regulators are really focused on. And so increasingly, banks are being told, you guys, you need to look at this, you need to understand who you're lending to, and you need to be answerable to a broad stakeholder group and not just shareholders. And there are real commercial as well as kind of, CSR reasons. And the real commercial reasons are you lending to organizations, to businesses that may end up with stranded assets? So if we can move to the next few slides, there are consequences and risks to this. If we can move through to the next few slides, populism is on the rise. And one of the consequences of that is that, if we could just move on to the next few slides, is that I think the whole framework for capitalism has changed. I attended Harvard Business School in the 90s, and shareholder capitalism was absolutely at the heart of what we were taught. And in fact, we had a famous professor who was basically the star. He was the popularizer of the whole idea of shareholder value, and Michael Jenkins was his name. And he, talked about that, and that was very much, you've got there the late Jack Welch. He was also, the great hero of shareholder capitalism. And what we were taught and what was promulgated by the likes of The Economist was, shareholder value is all that businesses should be worried about. They shouldn't worry about anything else. They should let other people worry about anything else. All that they should do is operate within the law and focus on shareholder value. That has changed. You saw the Business Roundtable in the US come out last year and say, actually, businesses have got a much broader responsibility, and it is towards social purpose and a range of stakeholders, be that customers, be that employees, and be that maybe future generations, with things like climate change. So a much broader backdrop. So a few other things that are happening. So if we look on to geopolitical tensions, and the next slide. So I showed you earlier that that there'd been a period of breakneck globalization from the 70s onwards. What this shows is that obviously we had that great dip that we saw earlier. This is a slightly different measure. This is percentage growth. But what this shows is that obviously everything shuddered to a halt in the financial crisis, but broadly a slowdown beyond that. And if we look to the next slide, it's a slightly different way of looking at this, which is that, again, trade has not yet returned to pre-crisis levels. If you look to the next slide, we're looking at the US and China. And obviously we've seen a lot of tensions, trade tensions between the US and China. So what this shows you is that the US has a much bigger share of Chinese exports than vice versa. So therefore, China is a lot more reliant on the US than vice versa. And not just that, but what this chart doesn't show is that actually exports are just a much smaller proportion of GDP. They're around 12% of GDP in the US, closer to 20% in China. And in fact, some in the US think, I heard Martin Wolf say he spoke to us last year, he said that the US thinks that it should be self-sufficient. So, and clearly there's a lot of tension and debate there about the extent of reliance on other countries, particularly during COVID. And so if we look to the next slide, this is just a way of looking at protectionist measures. This is looking at the way in which protectionist measures have been increasing in the US against Chinese exports. So you can see where they are at the moment, and it's possible that they could rise further. But even, I mean, one of the things that's interesting, and I didn't want to put in too many slides, but actually tensions were already rising even before the Trump administration. So this is seen as very much a Trump administration phenomenon, but it goes beyond that. So if you can move just swiftly to the kind of final few slides, this is just looking at where interest rates are. Brian alluded to it, and so it's just talking about the backdrop of low interest rates. And if we look at the next slide, we have seen that central bank balance sheets, they have swollen as a result. They're already big, but they've swollen as a result of the COVID-19 pandemic. And therefore, again, there's a lot of debate about the distributional consequences that we talked about earlier, which is basically in an era of low interest rates, the rich get richer. It also means that it's a difficult environment, as Brian alluded to and as Sean alluded to, for the banking industry, difficult to fat net interest margins in a world of very low interest rates. So a lot to take in there, but what are the big takeaways? Number one, globalization, which has been the driver of prosperity across the world for the past 4 decades, may go into reverse, may already be going into reverse. The model of liberal democracy that we thought had won, if you remember the Francis Fukuyama book, The End of History, we thought liberal democracy had won. It is now under threat in many regions of the world. And finally, the post-war world order, basically set up by the US under Bretton Woods, the World Bank, the IMF, all of those multilateral institutions, the UN, NATO, IMF, all of those, that alphabet soup, all of those institutions, multilateral institutions that underpin that post-war world order are under attack. So we live in volatile and febrile times, and that is the backdrop under which our industry is operating. So with that, Sean, I know that you want to open it up to a panel so that we can discuss this context for the industry.
Thanks very much, Margaret. I think those slides really drive home the complexity, some of these issues that the banks are looking at. So I might just remind everybody attending the webinar that it is possible to ask questions. So if there's a panel there on the right-hand side, if you have any questions, please send them on to me, and I'll do my best to raise them with the panelists. So looking forward to our discussion. I think we try to get a mix on the panel, so kind of a macro view, an investor view, and then a bank view. So I might just kick things off, and maybe Margaret, I might just ask you, if you don't mind. You mentioned populism and kind of governmental kind of interaction in your slides. Just wondering, what do you see as the real life impacts for banks in relation to those kind of areas?
Okay, so Sean, really good question. And I think that I would see that there are 2 big ways in which populism can affect banks. So most obviously, I think it can affect the economy. And clearly banks are leveraged plays on the underlying economy. Any bank is a leveraged play on the economy. But in particular, many banks are specifically leveraged to trade, right? Because they finance trade. So for those reasons, if there's anything that affects the economy, it's going to have an even bigger impact on banks. And I think that populism can affect banks through that mechanism of the economy. So we just saw that slide on globalization. Globalization has driven prosperity. Ireland is a very open economy that has really also benefited from being an active player in the world order and being a very open trading economy. So if there's anything that slows down globalization, it will slow down the economy and slow down and therefore have an effect on banks. But there's also another way in which I think populism can affect banks. And that's, look, frankly, banks have always operated in a highly political context. I think you would be naive to say otherwise. But I think that the decade since the financial crisis has been an even more political time. And I think you in Ireland don't need me to remind you about, some of the political constraints that have been put on banks, particularly when they've had government ownership. So over pay, over, at the moment during the COVID crisis, over dividends, clearly over regulation and the sort of way that, for example, in the UK, the senior manager regime affects things like everything from culture to kind of accountability. And also just, I think there's an expectation in terms of things like how banks operate in terms of, so it could be diversity and inclusion, it could be culture, it could be in the UK regions. The current government is very focused on a levelling up agenda. And so there's now a demand on bank boards to be accountable over a range of issues that, frankly, they would not have been accountable for a decade ago or a decade and a half ago.
Okay, thanks very much. Diarmaid, do you have any views on that?
Yeah, sure. Maybe if I take a more local view, and clearly in the last couple of years we've had a minority government here, which has led to opposition parties being in a position where maybe in the past they wouldn't have had an ability to propose legislation. And I suppose we're investors are very mindful of this. We're a small country in the periphery of Europe, but when I go to London, when I go to Europe or North America, they're very, very attuned to the political workings that are happening. So this is something that we spend a lot of time speaking with our investors, with bank investors on. And I suppose the key for them isn't necessarily just change. It is that there is predictable outcomes and situations that they can understand. So when you get uncertainty, and clearly populism gives rise to a lot of uncertainty, that is an area where it will impact on sentiment, and certainly you will have seen that in Ireland in the last couple of years. There was a proposal to look at the regime for tax assets. There were several proposals around the sale of mortgage non-performing loans, and also around the interest, proposals to cap interest on mortgage, for instance, as well. So all of those were areas where investors would have paid very close attention to. And, as I say, that gives rise to an uncertainty, which is typically something that clearly investors would not like.
Okay, thank you very much. Diarmaid, I might stay with you then. Just from an investor perspective, obviously the banks are going through a number of challenges. Like, what will investors, how do investors view that, and what will investors reward, I suppose? What actions will they reward?
Yeah, I think, look, even before COVID, the banking sector wasn't necessarily in vogue in Europe. And really, the crux of the matter is that the return on tangible equity available in the industry, didn't compare well versus where an investor might benchmark that to. So they sought other industries or other sectors where they could get better returns. And that, COVID to an extent exacerbates that, unfortunately. So that is a big issue in Europe. In Ireland, we've clearly had, as you both have referred to, low interest rates have had an impact on the ability to earn income. But you've also had credit demand, which hasn't recovered to the extent that you would have liked post-crisis. So we still have, to an extent, a level of deleveraging going on. So, I suppose those are kind of two areas where investors would typically, if they thought that those were going to look better, that they would look to. But, I suppose the sector today arguably screams very, very cheap, but that in and of itself isn't going to be enough to give rise to a renewed interest. They need a catalyst. So investors are looking for the catalyst here. Clearly catalysts could be macro or bank specific based. So if they saw COVID as something that was going to pass through and that there would be a strong recovery, then I think you could see renewed interest in the banking sector similarly. And, I'm not going to make any predictions here. It's likely to be very far off if interest rates were to be looked to inflect and to start to move back upwards. That would be a key interest for for investors. And clearly on a bank by bank basis, there is a number of things that investors would look for, but that catalyst is really the important aspect to attract kind of a renewed interest today.
So that concept of a catalyst, I think, is a really, really interesting one. Maybe John, if you could help us with this one. What are you seeing other banks do locally in the Irish market and more globally to grow in respect to that catalyst?
Yeah, hi, thanks, Sean, and hi, everyone. Yeah, I think it's actually, Margaret, I thought your presentation was super. Just when you take back the full complexity of the background environment, social, technology, demographic changes, like it all feeds in. And I think one of the challenges for banks, both in this market and elsewhere, is that when you step back and you look at that, I think really it consolidates down into two big things. So one, I think, on the back of COVID, we're going to see structural changes in customer demand and in behavior. So we're going to see the demand for what people want from banks is going to be different. Their needs and preferences are going to be different. And I think we're going to see a real acceleration of digital solutions emerging out of it. And particularly for banks in Ireland, when we look at how, new entrants into the market have disrupted it, those are things that we need to respond to. And I think secondly, then there's going to be fairly big structural shifts from a banking perspective. So, how do we grow revenue beyond traditional balance sheet and transactions? How do we start to think about ourselves as platform businesses or, entering into new marketplaces? And, how do we really drive a step change in productivity and efficiency? And I think, what would be a catalyst? I think the current environment is a catalyst. We've come through COVID. We've had an absolute shock in terms of demand. But to recover from that, I think banks both have to provide new incentive and new meaning for customers to do business with them. And as Margaret said, we're a leverage play on the economy. So how do we help reinflate the economy, and how do we make sure that there's funding and support available? And secondly, as I said, with that acceleration of technical and digital trends, I think it will allow a lot of things in banks to get out of the way that were there previously, and we have to be able to respond quicker and stop sort of, living off that endowment effect of big back books. With moving into negative interest rates, with tightening of spreads, we have to come up with new and better ways to justify why we're useful to our customers. So I think the catalyst is there. I think it's how people respond.
Margaret, would you have any views on that?
Well, I mean, John hit the nail on the head. In terms of, for example, I think he's absolutely right that this has been a shock and a catalyst. I mean, there are lots of books. Many of us have been reading our history books about the 1819 flu pandemic and the Black Death, and of course, pandemics are massive shocks to the system and are big catalysts for change across so many dimensions. And I think that John is right in terms of there's going to be a massive push towards digitalization and digital adoption. I mean, even elderly people who wouldn't have gone digital before have gone digital. We've also done another piece of research about working from home. There's been, obviously, we've all been, you can tell from the backdrop, many of us are still working from home. So that's been a big shift. And clearly that's driven a lot of soul searching about what the business model looks like. And certainly banks and across FS financial institutions here are asking, not just what the real estate footprint looks like, but also what does it mean in terms of reshoring? Should we be reshoring? And also, should we be automating? So massive questions about the business model. And John is also right, just a point about the platform. I mean, we have looked at the valuation of various businesses, and I'm sure you all have, and the FANGs, the big social media companies are on astronomical valuations, and the banking sector is not. But actually, if you can find within the banking sector a platform business, like for example payments, that might be one way at least of sort of just having a step change in terms of how the business is perceived and valued.
Okay, thank you. I think the other part of the equation when we look at the business model is obviously just around costs. And part of the challenge there is obviously, in the initial phases, taking the low-hanging fruit, and you can get quite a lot of gains quite quickly. But after that, then you need to start looking at investing, and it's hard to navigate that tightrope, I suppose, between cutting costs and spending money to cut costs further. I don't know, John, maybe would you have a view on that, and what are you seeing in the market there?
Yeah, thanks, Sean. I mean, look, I think it's definitely it's a tightrope, okay, because there's only so much cost you can take out of a traditional business model before you start to impact what actually makes that, a strong and resilient business in the first place. I mean, I certainly know from our perspective, and we've been public about it, our cost base is too high. So that means that we have to find ways to start to reduce that in a systematic way over time. And we've had certainly for the last, 24 months, we've had a fairly consistent, solid drumbeat about that. But I think, again, when you think around the level of disruption and the background to it and those new competitors coming into the market, again, you have to come back and say, well, okay, well, what are the levers available? And you have to invest to remove portions of those costs, because really it's about how you use technology to drive cost efficiency, and that can come in right across the board, whether it's your cost of production, your cost of distribution, how do you get better service outcomes. I think the second piece is just around the traditional sources you would always go to in terms of your property footprint, the spread of the business, even down to taking some of the discretionary stuff you don't really want to go after in terms of marketing budgets. And then thirdly, it's making sure that you're resilient, because if you overdo it in terms of the cost side, can you ease into the resilience of the business to respond. And certainly, we saw, certainly over the last couple of months, things that we would have felt had been great for a lower cost profile in the past, had unintended consequences. When you get something like a global pandemic, some of your offshoring doesn't work in the way that it should. So it's to pick up that point from earlier, how do you start to automate a lot of that activity and really, get the cost base fit for purpose, but investing for what and for what future? And as Diarmaid would tell us, you have to give investors a reason to invest in the business, and we have to try and make that compelling. And it's not easy in the banking sector.
Right, Diarmaid, that's a good intro for you. What would be the investors' view?
Yeah, I think cost has been, for a long time, as long as or any of us, I think, have probably been involved, cost has been a key topic for investors, and it will continue to be. But, I think I'd echo John's point. You can continue to take certain costs out. You won't get value for it unless you can demonstrate that there's a sustainability to what you're doing, so that it isn't a one-time effect and then in a couple of years' time it drifts back up again. That you can really do that in a meaningful way so that it's actually changing your operations, and that's something that investors are looking for. And I think you're right. There is a fine line or a tightrope there that does need to be walked through, because investors will assess who is good and who is not at these ultimately, and they will look at the level of spend to per euro of cost that's being extracted, and they will benchmark on that basis ultimately, and the ability of a bank to deliver on a transformation program is very, very important from an investor perspective. I suppose the other key point that they were making, and John touched on it as well, is that investors will get very, very concerned if they see cost cutting and it begins to erode into the revenue base. And a lot of cost cutting programs over the last 10 years had some unintended consequences, and therefore there's a wariness where there isn't a level of detail being provided by the bank in terms of what the ultimate impacts will be, and that's something that banks need to be very mindful of as well when they approach that.
Okay, thanks for that. I might just pause to see if there's any questions. Just remind everybody just to attend the webinar. If you'd like to send any questions into the panel, please just put them in there in the right-hand panel, and I'll do my best to get them in front of the team here. Just want to move on then. I suppose we've talked about COVID quite a bit, and the potential changes around that. How do we really think it's going to transform the banking industry, and just how sticky do we think some of those changes will be? If we're back in our workplace in 2 years' time or a year and a half time, will we all forget about it, or do you think these changes are here to stay? Margaret, I might get your view on that.
So I think that we have alluded to some of those changes already, Sean. So one is digitalization. So that is a journey that the industry has been on, frankly, for the past 20 plus years. But clearly it's been accelerated because even the elderly, even sort of some of the, slower adopters have been forced to kind of adapt to those kind of digital means of distribution. So digitization, I think, is going to be accelerated. But beyond that, clearly, I think the whole business model. And so, to my earlier comment, I mean, we did this whole piece of this survey called The Future of the City. And at first we thought it was just about, the future of the workplace and, the impact on offices and the real estate footprint. But actually, when we got the survey results back and took them out to clients, what we have realized is that actually banks and all of those other financial institutions are kind of really asking profound questions about the business model. So we think that there will be a move towards more automation and maybe also some sort of reshoring. You'll have automation, reshoring, and maybe even for us sitting in the UK, maybe even a kind of a look at where banks are operating, where their operations are within the UK, and perhaps less in the City of London. And finally, I think the whole focus will shift from efficiency, which of course we've all been obsessed with kind of just-in-time means of manufacturing, efficiency in operational efficiency, balance sheet efficiency, and there will be more of an emphasis on resilience. Now, in theory, there has been that emphasis all the time. Certainly in the UK, the Bank of England has asked. There've been pandemic plans for well over a decade, but of course, we used to think that the way in which the business continuity plans would all have to be about, say, relocating to Croydon or somewhere. No one really thought about it being a mass kind of relocation to working from home. So that whole question of being prepared for disaster, whatever form that disaster might take, I think that's going to be something that we're all going to be looking at more in future.
John, I was wondering, do you have a view on that? Is COVID, the changes here to stay, or are they going to have as big an impact as we all think?
Well, I think kind of, what are we, 120 days later, I mean, I'm still here in my living room, right? So it takes about 90 days for a habit to get ingrained, it just has to, Sean. Now, maybe in the long term, and again, I think when you look back at some of the charts we saw earlier in the presentation, things can seem huge and impactful now, and then in the long panorama of history, they can be a blip. But I think from where we're sitting right now, we don't know. But it certainly feels as if there's going to be some fairly significant changes, certainly over the next 3-5 years. I think it's just accelerated certain social trends. I mean, we're all doing this via webinar. We're not sitting in a hotel anywhere. You've got to change the way that you network and you engage. And I think that's going to drive out different strategic developments, both in terms of how we embrace technology. I think there's going to be a fundamental shift in terms of the profit model, particularly when you look at the amount of stimulus that is going to have to be continued to be pumped into economies. How do you get that money to where it needs to be, and what's that going to mean for banks' balance sheets? I think then when you look across banking in particular, there's going to be a change in terms of just that ongoing development of the regulatory environment. But fundamentally, I think the way people want to engage with financial services has just been given an almighty turbo boost, and I think people are going to struggle to catch up. So for me, I think we will see long-lasting change. I think we'll make some wrong plays and assumptions and bets along the way. But I definitely think we'll see a fundamental shift in the way we have been operating for the last 10, 15 years.
Thanks. Really interesting. Just might move the direction a little bit now. Obviously, the ECB has just recently released a consultation paper on banking consolidation. And it does seem to be a greater need for M&A in the industry, maybe driven by cost, maybe driven by competition with the US banks. How likely do you think it is that we're going to see greater kind of banking consolidation across the EU and even in Ireland? And what would you see as the main obstacle to that? So maybe Diarmaid, would you mind answering that?
Sure. Thanks, Sean. I think, look, obviously one of the intentions of the banking union was to make M&A easier, because there was a number of obstacles when you had in-country regulation as opposed to pan-Europe. So that was one of the starting points. But I suppose when you look beyond that, then there is still different legal systems across Europe, and you have other challenges even within market mergers, as we see in Germany last year with Deutsche Bank and Commerzbank, where you've got political and kind of union engagement that potentially blocks a merger going on. But the longer term trend is there are far too many what believed to be large banks, if you like, in Europe versus what you have in the US. You know, we see the US bank results come out today and yesterday, and you know, the banks that have done well are the banks that are very well diversified, that are not overly reliant on interest income in this case, and you know, they're able to continue on with their operations. Yes, they have challenges, but you know, in some instances, they're able to continue paying the level of dividends, etc., that they wanted to. So, you know, areas like that will give rise to that need for further consolidation across Europe. You know, if I take Ireland as an example, you know, clearly investors look at it and look at the return landscape across the banking system and wonder if further consolidation, and we have consolidated a lot already. Let's not forget how many banks were here in 2008, for instance. But you know, they would still see that as an option. You know, clearly, why has that not happened? You know, banks have been looking to tidy up non-performing loans. You know, they've been dealing with legacy issues for the last number of years. Some of that, if COVID hadn't happened, maybe we would be getting towards the end of this year, and maybe at that point you would look at it. You know, but there's still a little bit of a direction to go, I think, before you do get that meaningful merger and acquisition kind of a catalyst going, if you like. And you know, I think Brian referred to Jean-Pierre Mustier, and you know, he was asked at a UniCredit Day in December last year about M&A, and you know, UniCredit is regularly touted as a bank that can go out and do that. And you know, he said, look, I have a lot of problems that I want to look at, I want to improve within my own bank before I do that. So that's the backdrop from a leader, if you like, in the industry. That's their thought process at this point.
Okay. I might, no panel discussion would be complete without mentioning Brexit, so I might just ask maybe Margaret, what's your view on Brexit, and how's it likely to impact European banking industry and Ireland potentially as well?
So clearly the context for Brexit changed dramatically last December when we had a UK general election with a very big majority for the Conservative Party, which had fought on a kind of basically a Brexit manifesto. And so it looks as if we will at the very least have what used to be called a hard Brexit, and it may in fact, there's even a chance that it will be a no deal Brexit. So clearly, certainly in the UK, that's going to have a big impact. We already have had a massive negative effect. We're in a recession thanks to COVID, and certainly a no-deal Brexit would complicate matters further. So certainly in terms of just the economic backdrop, which is always important for banks, tough for the UK. Still a big question mark over what it means for Northern Ireland. As I understand it, that is very far from being resolved. And clearly, given the very close links between the UK and Ireland, I would expect it to have an impact on the Irish economy as well. Now, in terms of things like the operational model and the structure of banks, we believe that most banks are pretty much ready for what we would call day one. In other words, they have got the authorizations in an EU 27 country, be that a banking license, and of course we know that there are quite a few companies that have got Dublin as their European headquarters. So we think that in terms of those licenses, the licenses are in place. We think that the people for day one are broadly in place. There've been a few hiccups with COVID. However, we do think that there will be day two and beyond impacts. So we think that many businesses, particularly non-European businesses, will find that the way in which Brexit has forced them to operate is inefficient. And this is in the context that Diarmaid well knows, which is that the industry has not made its cost of equity broadly across Europe since the crisis. So it is not a very good backdrop. It is becoming even less efficient as a result of Brexit, with capital, liquidity and expertise being split. So we certainly are expecting that there will be further impacts, once Brexit has, not just obviously Brexit has happened, but once the transition period is over at the end of this year. So we do see further reverberations across the industry and for the UK and Irish economy.
Thanks, Margaret. My apologies. We have a question through from the attendees, and it's just around quantitative easing. And the question around, given that quantitative easing and the flow of money won't be necessarily directed towards the banks this time, do we see the panel that this may lead to a period of hyperinflation within the European economy? So I don't know if anybody has any views on that.
My own view is that we're unlikely to see hyperinflation in goods. We may see some uptick, but we are. One of the things that has surprised me has been the way in which asset prices, in particular share prices, recovered so swiftly after that massive sort of sell-off in March. And in some indices are back to where they were before. So to my earlier comment about distributional effects, when you've got very low interest rates and quantitative easing, what ends up happening is that money goes somewhere, and it has tended to inflate asset prices, and that's certainly what would seem to explain the conundrum and the mystery of what are still very quite high equity prices, for example, given the macroeconomic backdrop. But Diarmaid doubtless has been running models on this, and I suspect we'll have a more sophisticated view on this.
Yeah, I'm afraid I don't have one on hyperinflation, but investors, I don't think are all that worried about, or it's not top of their agenda in terms of hyperinflation at this point. But certainly you do see some papers coming out from some of the leading research houses who do talk about inflation, because I suppose what is the quantitative easing doing? It is offsetting increased spending by the government effectively. That's what, in a lot of examples, what they're looking to do. And, I suppose, that's an area where in the longer term, I think it's probably a little bit too early yet to make a call on, but certainly, we've had very, very no inflation practically for a number of years. To what extent does this give us some inflation? I think over the next 6 to 9 months, we'll probably have a better view at that point.
Okay, thanks very much. Okay, so just as we move into the latter part of today's panel, I'd like to probably just focus on some of the growth areas, and maybe bring it a bit more upbeat as we finish off. Like if this might sound like a bit of an interview question, but where do we think the Irish banking industry will be in 5 years? What does it look like? Who are the main players? What are the main products? What do the distribution channels look like? Just be great to get the panelists' view on that. So maybe John, if you could start.
Right, sorry, Sean. Yeah. I think it's going to see quite a bit of a shake-up. If you look at new entrants into the market, I think we're going to see is a real mix and tension between, can banks provide the type of services that customers want going forward? People's expectations have moved along at a really fast pace. I think you might see some consolidation, but as Diarmaid will tell you, there's been talk of consolidation in Irish banking for, most of the last decade, and it hasn't occurred. I think, it's still a relatively small market. I don't think that it's underbanked. I think there's some new parties have come in, whether it's on the mortgages side. I think you'll see a lot more competition around the origination space. So, we look at something like mortgages, we're seeing quite a resurgence in terms of, brokers and intermediaries. I think you'll see lots of new firms coming out, just making that customer journey a bit easier. And I think the big question that we kind of looked at earlier, but I don't have an answer to, is, will you see consolidation with new entrants to the market, either in terms of European banking starting to consolidate, or will those kind of populist nationalist borders just act as a repellent to it? But I think either way, we'll see banks will have to restructure their business model. We're going to have to be much faster, much more efficient, and I think you'll see the emergence of new revenue streams as well, maybe new ways of doing business. And I think for anyone who's working in the banking sector, I think what we've seen in terms of some of the changes and shifts in culture over the last couple of years, I think we'll see that accelerated pace as well. I just don't think that the industry will move at a pace that won't allow us to become much more agile in terms of operating model, much more responsive to immediate feedback. And I think you'll see a lot more investment on the technology side.
Thanks.
I give myself a D for that answer, by the way, Sean.
Excellent. Just on culture, you mentioned culture there. Obviously, that's high on the agenda for regulators and the banks themselves. And there's quite a lot happening in that space at the moment. Like, what do we think? What kind of impacts do you think those cultural changes will have over the next couple of years? Margaret, maybe if you'd like to have a look at that.
So culture is really huge, and funny enough, when I first joined Deloitte, which is 8 years ago now, we did a big survey of senior bank executives across the world on culture, and the big takeaway from that survey was that 2/3 of senior bankers thought there was a problem in the industry, but only 1/3 thought that there was a problem within their own banks. So I think that tells us an awful lot about kind of where the industry was at that point. And clearly there's already been a huge journey on culture. It's been a huge focus of certainly the Bank of England, and there are various elements of culture that they really focused on, not least pay and incentives, but also of other central banks like the Dutch Central Bank, which has taken a somewhat different approach. I mean, and this may be instructive about the different culture within different countries, but the UK has taken an individual approach and focusing on the individual, whereas the Dutch have taken a group approach and they focus on group dynamics, which I thought that was quite interesting. And by the way, there's a lot of literature on the websites of both banks if you're interested in this subject. But I think that culture, actually the other interesting thing is we did another piece of research on talent, and on, when I talk about talent, I mean grads and which industries graduates want to go into. And what we found was that there had been a shift in favor of tech companies and away from banks. And the other interesting thing we found is that banks were perceived to be basically not very good on a bunch of cultural things, whether it's diversity, gender diversity, basic corporate social responsibility. Banks were not seen to be good on that, but equally the people who wanted to apply to banks didn't really care about all of that. And I think in the context that John was talking about, all of those big cultural shifts that are being accelerated by COVID, I think a world in which banks are seen as sort of fuddy-duddy and reactionary is, or even, however unfair that perception is, that is not a perception that I think is the perception that you want to be living with. So I think that the world is changing. We're seeing huge kind of movements, be it Black Lives Matter, be it Me Too, be it any of these movements. There is a real desire for change, particularly amongst the millennials and the young and Generation Z coming up behind them. So I think that is something that banks are going to have to respond to very proactively.
Yeah, and I think, sorry, I was just going to say, Margaret, I think it's almost, and I love your example of 2/3 thought it was the industry and just 1/3 own bank. And I think when I reflect even on our own journey, at times, it was, personally, I probably started myself, well, there's a big problem elsewhere and with other people, and it's only when you're sort of, you have to go through what the industry has been through over the last few years, be it trackers or other items like it really does force you to reflect and go, actually, are we really putting what matters first? And I think it fits in with, the broader sort of ESG type factors as well that are coming in as part of an investor side. But like it does start with the self, and I think you have to have a bit of introspection first and realize, well, if you don't change your own style of leadership, your own approach to engaging these things, you then have to work with the broader culture piece. So I think it'll just be a huge feature of the industry for the next couple of years.
So with that, I'd just like to thank all the panelists, Margaret, John, and Diarmaid for joining us today and putting all the hard work into the prep beforehand. I'd like to thank the team both in the BPFI and in Deloitte just for helping us make today happen, and then obviously everybody for attending also as well. Today's webinar will be available on YouTube from what I understand. And I'd just like to say thanks again to BPFI for working with us on this series of 4 webinars. Thanks, everybody.
Thank you.